Welcome to the SNF Spotlight series. I'm your host Yitz Rubin, and in this series we will be speaking to some of the healthcare leaders who are making a big impact in the industry. Join us as we shed light on a variety of topics that will benefit both our SNF colleagues as well as the general public. Welcome to the SNF Spotlight series. Today I have the privilege of being with Mark Meyers. The second time I met him, actually. The first time was in ECAP, so there were two of him, and the other one was nicer, but...
You got what you got.
Yeah.
Sorry.
So Mark, welcome, and thank you for
you.
coming on to the SNF Spotlight. I really appreciate it. So you're the executive director of Walker Dunlop. Can you tell us a little bit about that?
So Walker Dunlop is a large finance company. They do a lot of what's called GSE loans, government service entity loans, so Fannie, Freddie, and HUD. They formed a multifamily investment sales group about 6 years ago when they purchased Angler Financial, and they wanted to grow their investment sales platform, and they wanted to bolt on a senior housing group to accomplish part of that goal. And so they did that by purchasing our team from where we were at previously, and so they did that 2 years ago, and we came over to the firm. It's been very beneficial for us and more so for our clients, which is the most important thing, because we now have access to the financing I mentioned, as well as bridge financing and insurance financing and some commercial debt as well. And Walker & Dunlop also has its own internal financing, its own balance sheet that you use for bridge financing at times for various product types. So it's been very collaborative, and COVID obviously was a challenge for everyone, but it's been a great 5-6 months here of 2021 with closings for us and with business, in the pipeline. So yeah, it's been a good move.
You had mentioned it was better for your clients. In what way was it better now that you're with Walker Dunlop?
Well, there's more optionality. Our clients can either go the refinancing route, or they can sell their properties, or a combination of both, where in 3 transactions recently this year, last few months, we've sold the seniors housing properties for the client, and we brought the financing for the transaction too. So we were able to effectuate a very smooth transaction because we were quarterbacking the whole process. Whereas if you're selling the properties but someone else is bringing the financing, now you're much more at risk of the financing source not liking the appraisal, or slowing the process down, or whatever it is. But when the financing is being not controlled by your own firm, but sort of quarterbacked by your firm, you can talk to your own financing sources and find out, what's going on here. You can push them a little bit to move faster, or whatever it is. So it's been a really good experience so far.
So Mark, your clients are typically SNF owners and operators, or is this also assisted living that you deal with?
So half of our business is assisted living and half is skilled nursing. So we've closed about $2.5 billion of skilled nursing and about $3 billion or more of seniors housing. So it's a little bit more skewed to assisted living, independent living, senior apartments than skilled, but it's about half and half. My partner Josh and Brett on our team, my other partner, they're focused a great deal on the seniors housing space, and my focus is a bit more on the skilled space. So we divide and conquer, if you will. With the financing versus the investment sales process, we don't actually run the finance process. On the HUD side, Josh Rosen, or in the South, Kevin Giusti, quarterbacks those financings for our clients, and we concentrate on closing the sales transactions. And if it's on the Fannie or Freddie side, we work with Russ Dye on the East Coast, and Jeff Ringwald and Bill Jackson in the South. So once again, we divide and conquer the financing process. For example, we closed a $165 million portfolio of independent living properties in Atlanta earlier this year, and Russ Dye put the financing on a good portion of the package, and the other financing was assumed from PNC Bank. And so Russ, by and large, ran most of the financing process, other than the business dealings between the seller and the bank and the handoff with the assumptions. But the new financing was quarterbacked by Russ, and then we ran the sales process. I personally invest in skilled care facilities and assisted living facilities across the country. So I personally am involved in ownership, but Walker & Dunlop is not, per se.
How did you get into this originally?
I was an asset manager for multifamily properties in places like Louisville, Kentucky, and Austin, Texas, and Memphis, Tennessee, for a small real estate syndicator Group 1 investments in Chicago. And I had just completed my MBA at Northwestern. They call it an MM, but basically an MBA at Northwestern, Kellogg School of Management. And didn't start my own little business. Bought into a franchise that didn't work out, the Blimpie sandwich franchise, if you've ever heard of it. And my wife and I were going to, build up a handful of those and run those. And for whatever reason, for a lot of different reasons, it was not a good decision. I was in my young 30s and I should have made a better decision, but we didn't. So we got out of that. And then the whole time we were trying to do the franchise thing, I stayed in real estate. I was always in commercial real estate as an asset manager back then. Started off in bookkeeping. There was a broker who handled a couple transactions for Group 1 investments and made a lot of money doing it. He was having fun. I thought, this is really a good career. And so I cold called CBRE and Marcus and Millichap and probably one other firm. Ended up at Marcus for 26 years, actually. And when I started there 26 years ago, I was selling multifamily. I had all kinds of engagements that I had procured, but I was having a lot of trouble selling the properties that I was taking in because some of them were in rougher areas of like Aurora and that part of the Chicago suburbs. I went to talk with the ownership of Marcus and the managing director of our region, and I said, having a lot of trouble with multifamily. I'm taking the business, I just can't get anybody to buy these properties. So he suggested, Linwood is his name, he suggested that I consider going into seniors housing because they needed somebody to cover that space. We were independent contractors, and so we kind of all ran our own silos, our own businesses. So I thought, well, specialization is a good thing. So I jumped into seniors housing. I wouldn't say with both feet. I think I'd say maybe jumped in with one foot, kept a foot in multifamily for a while. Sooner or later, people realized the value that we could bring. I mean, if you look on the closing statement, the brokerage fee, it's a big number, and so it's like you have to justify to people that by using a broker, you're going to garner a much higher return on that investment or that cost than not hiring somebody. It could be a beautiful thing. I mean, it's not easy. These SNF transactions are very complicated. They have a myriad of issues that you face, including licensure issues, operating issues, census issues, quality mix, referral sources.
It sounds amazing. I actually have a little bit of a background in real estate. I was a real estate broker for quite a while, and just putting those pieces together and helping an owner understand the value of their property, giving them that advisory, especially something so complicated as a skilled nursing facility. It's not an easy sale. It's not like there's so many pieces, so many barriers, and you've seen the market fluctuate over 26 years.
Yeah.
So would you say like nowadays things are changing? In what way would you see the market, and what do you perceive coming on in the future?
We're very grateful for and reliant on companies, and you didn't ask me to say this, I will say this up front, but companies like Aperion. I mean, it's the private companies like Aperion and companies like them that create the liquidity and the flow, particularly during bad times. So take COVID. COVID hits, the pandemic hits, the world is just in an uproar. The nursing home community, by and large, the Orthodox community specifically, was very calm about things, and they had experienced COVID themselves during Purim and then shortly thereafter and with other events, and they had lived through it and they've suffered through it, and they were not scared off by it, and they were aggressive, and there were a lot of reasons why they fared fairly well during COVID as far as operationally, and they sort of got their act together and that sort of thing. And quite frankly, I would credit them, if you look back on the transactions and how many of them were completed by the Aperions of the world and companies like them, it was most of the transactions. And so when Genesis was selling, picked up almost all by our Orthodox clients, and when Kindred was selling, Blue Mountain Capital, bought the package or contracted on it, but then they sold off to all of these regional groups like Aperion. So I would say that the drivers of innovation and the drivers of the space literally are these companies like the one we're sitting in now. They're faster, they're smarter than a lot of companies, and they innovate and they operate well. They truly are the leaders, of the industry. So I think they're taking the industry where it should go, and it has changed a lot. I mean, when I first started, it was a very custodial business, and it was run by a lot of fairly unsophisticated mom and pops. I mean, this company, again, that we're sitting in now, highly sophisticated. I'm sure you have systems here that would blow people's minds. But when we first started, it was like all paper, and it was very much a mom and pop business. And then as it became more complicated, and as hospitals had a real need through the DRG system to extricate themselves from the patients from the hospital as quickly as possible, but be able to trust that there wouldn't be a readmit to the hospital, and trust the nursing home would care for very complex residents. I mean, some of these residents have multiple comorbidities. They have diabetes, they have hypertension, they've had cancer, some of them, or strokes, and they're 86, 87, 88 years old. That's what a lot of people don't realize about seniors housing is everything from independent living through subacute care. They're all 85 plus years old, 84, 85 or older. Some are 100, 105. I was in a nursing home in Detroit 3 weeks ago, and there was a lady who had just passed who was 114. So these are very, very elderly people. Their last place to live will be this facility that they're in, and we're caring for them, and companies like Aperion are caring for them. And so hospitals had to learn to trust the nursing homes to care for these very frail, very old people that are on their last years. And so as the population aged and became sicker and older when they entered nursing homes, it became more and more important to develop good wound care, to develop good trach care, respiratory, renal care, all these things. And so now you can't just be a plain vanilla nursing home. You have to have a lot of specialty care programs, and I think that's only going to become more and more the case, in years to come. I think, thankfully, because of the vaccine, we could have lost a good portion of our elderly population. It was sort of heading, right? It was sort of like the trajectory was kind of like, if you lose 60 in this nursing home and 90 in this nursing home and 30, it could have been really, really bad. But I think the nursing home industry was, while we weren't prepared for a pandemic, I think the response to the pandemic was such that we corrected things really fast.
Would you believe that now would be a good time to buy if you were an owner and an operator?
I think it is. I've heard both sides of that. I try to be fair in my assessment, even as an advisor. I think the market's clearly hot right now. I think it's hot because of stimulus money and other things that have been pumped into the industry and into the economy in general. There are a lot of people with a lot of money for that reason as well as others. The interest rates are very, very low. You can borrow from HUD at sub 3% for 35 years non-recourse. Whoever's heard of such a thing? So if you can borrow at 2 3/4, 2.9% interest rate, and you can have a non-recourse loan for 35 years, why not? And then you have a year one stabilized cap rate of 12.5%. There's no product type out there. Industrial's not going to give that to you. Dairy Queens, Burger Kings, they're not going to give that to you. They're 4.5. Our investment sales division in the multifamily side sells AAA apartments. That's what they concentrate on. So they're doing deals at 3.5 caps in some markets. So you have a 3.5 cap deal with a 3% loan. Maybe and those loans aren't 35-year amort, they're shorter. So maybe you have a 3.25 to 3.5 constant, maybe even a 4 constant. So you either have a cash on cash of 0, or maybe even slightly negative, and you're hoping to make it up on the reversion and make it up on the rent increases, and maybe you improve some units and you raise the rents. In our business, though, there's like a
much
900 basis point spread, and I think that's very attractive to people. And so as interest rates fall and cap rates stay the same, the spread just gets wider and wider. And so,
Mark, now that stimulus is probably not going to be happening anymore, there's not as much money pumping. Would you say there's going to be a lot of deals of nursing home owners and operators that won't be able to hold on?
There'll certainly be some. Some of the nursing homes where I've been an investor, we've had our share of struggles, just with payroll, and because staffing is a very difficult thing now. Anyone that sits in this chair, and talks to you and says that's not our biggest issue, I'm going to go out on a limb and say I think it's worse than COVID. I think the staffing crisis was worse for our industry, is more dangerous, or more of a challenge. I don't want to make light of COVID, but COVID kind of came and went. This staffing crisis, it's a terrible, terrible issue, and I think it's created by 4 factors. It's created by we're asking people to take care of challenging folks that have Alzheimer's. They may not treat you well, and you have to change adult diapers, and change bed, whatever it is, and it's like you're getting paid, maybe $16 to $18 an hour if you're lucky, if you're a CNA, but call it $16, $17 an hour at best. There are companies where certainly if you learn how to do a little software underwriting, whatever, you're making a whole lot more money in an air-conditioned building without these challenges that we have in our industry. So that's one factor. And then so you've got the higher pay from jobs that are less strenuous. And then I think you have the stimulus money paying people not to work, which is a factor.
Yes, that's what I thought was the biggest factor. The largest factor was the government paying people not to work. Is that what you would attribute to? Because why wouldn't there be staffing issues prior to COVID as well?
You'd have to have an algorithm to figure it out, because I think there are a myriad of factors. I think there has been a resurgence. If you think of what happened during COVID, one of the things that was unanticipated was the explosion of the digital world. So what COVID did was it put pressure like forming, a diamond or obsidian or whatever rock. It was like that pressure on the earth to create something. I think COVID put that pressure on the economy and on social trends. And so one of the social trends was people using, Amazon and Uber and things like this. So things where you could just order something online, Zoom and all these things. So whereas people may have used it, even me, like you used it once in a while in the past, now all of a sudden you don't even think about anything else. I'm not going to the store. The store may not even be open, but even if it is, I can get it cheaper, I can get it faster. I'm doing this, and my wife's very committed to going to the store and keeping the stores open. And I think she's right to a certain extent, but the reality is you go to the store, it's 5 to 15% more, maybe even sometimes 50% more, and sometimes you have to wait for it to be in stock, and it's like Amazon is there the next day. I think these digital companies just exploded. Look at their stocks, and people were on Zoom and YouTube and Google, and so I think those jobs became even more attractive, and they were in more of a need. So I think they've probably been able to raise their prices and offer benefits. You hear about these jobs the young people have at these companies, and they have wonderful, not entertainment, but they have places that people can interact and stuff. And then they go into a nursing home. It's not the most, not the prettiest place in the world sometimes, and you're taking care of tougher people and stuff. So yeah, I think I think before COVID, the digital world didn't explode quite as much as it has, and I think it's been pressed even further during COVID.
So Mark, dealing with initially multifamily housing, how would you say that differentiates between a SNF?
Virtually every 20-something-year-old that exits college is going to live in multifamily, and then empty nesters and some others are doing it by choice. Renters by choice, they're called. The percentage of young people, they're going to live in an apartment. Even if they move in with their girlfriend or boyfriend, whatever, they're probably going to live in an apartment. And once they're married, the first couple of years they may live in an apartment. So you have that whole segment of society that has a great need for multifamily, and there's more of it, of course, too. With seniors housing, I think you only have 1% of all seniors in seniors housing, and then you have about 10 to 12% of the age income cohort that's eligible or targeted for seniors housing that takes advantage of it. So all seniors might be from people, 60 some years old and older, but that component that is in, as I mentioned earlier, that's in independent assisted skilled nursing is probably 84 years old and older. So if you look at that segment of the population, 80 and older, 75 and older, and then you use maybe a $35,000, $40,000 annual household income, that's kind of the age income cohort that we look at. Of that cohort, there's only about 10 or 12% of them that take advantage of seniors housing. Why is that? Well, they are living in their own home, and they've been independent for years. I was with a 94-year-old man yesterday, fairly healthy, lost his wife 30 years ago. He's lived on his own. I think that's fine for many, many of them that can truly make it on their own and that have some sort of socialization, some sort of community. I think what happens to a lot of folks, and I think more and more of them are learning that just because I can take care of myself, if I have no interaction with people and I'm not playing bridge or poker, or if I'm not shuffleboard, or if I'm not going to the games with someone, or I'm not at the casino, or if I'm not going to a concert, and I'm not learning about travel and so forth. I'm just kind of like watching TV all day, and my father-in-law kind of fell into this trap for a couple of years when he lived with us. So he was even with us in home where we were playing games with him and so forth. But by and large, he sat and watched tennis. He had a stroke. He couldn't talk very well. So he spent most of his days watching tennis. We put him in a senior housing facility, or he chose to go into one, and we worked with him on that in the Chicago area about a month ago. Like, he was like becoming like gray and not walking, and he looked like he was near death. And now he's like, bright and cheery, and it probably helps that 2/3 of the people are women in his facility. But he's playing bingo and pinochle.
Tell us more about that.
Yeah, exactly. No, he doesn't have a girlfriend. But no, in all seriousness, he looks much healthier. First of all, he's walking more. He has to walk to breakfast and walk to lunch, and he walks to bingo. And he's interacting with people his age. I think there's a very powerful thing that happens when 85-year-olds are with 85-year-olds. 85-year-olds that have had strokes and are with their children who are perfectly healthy and running around like crazy. And one daughter plays volleyball, the other one's in theater, and they're coming home and they're sharing with Grandpa. But Grandpa, can't do any of that stuff anymore, and it's discouraging to him. And he used to be a very active person. So now he's with people who used to do the things he did, and there's a powerful connection there. So I think seniors housing will bring people out of the woodwork more and more year to year. Versus multifamily, it's something we have to pull people into a little bit more than multifamily. There's not that natural need.
So would you say also multifamily, it could be a lot more profitable going into senior housing as opposed to on an investment standpoint?
There are like two rules of economics that I say, for sure that the world lives by, every part of the world, and that's, supply and demand, and also risk and reward. So, the higher the risk investment, the more the reward. And clearly seniors housing in general and skilled nursing in particular is a much riskier business than multifamily.
But with a much bigger upside.
Much bigger upside for a couple different reasons. First of all, that cap rate spread, the 12.5 cap versus the debt at around 3%. So our debt isn't that much more expensive, and sometimes with HUD may even be the same or lower cost than multifamily debt. And yet the cap rate is, in some cases, triple, maybe even quadruple what it is for, close to quadruple what it is for multifamily or industrial. So there is a lot more profit potential, in addition to the fact that, again, good companies like the one we're sitting in here, they have ancillary companies like, some of them have PT, OT, ST, wound care. Some of them have their own agencies. Some of them have their own HMOs. So by building a platform in a region and plugging in these ancillary companies, theoretically you could break even on the nursing home operations and still have a very good business going with all the ancillary companies that are servicing those nursing homes.
But would you say, when you're selling a nursing home, would you say that should be a model that some of the younger people, some of the younger owners and operators may take on?
Yeah,
to value this nursing home, not just on its own right, but also on the ancillary side?
Sure. I mean, we don't necessarily price the profit centers in the offering because we don't know. We're selling to a broad audience, so we don't know which ancillary businesses a particular owner will have. But what we do is target owners who want to be in a certain region to bolt on facilities. If it's 5 or 6 facilities like the ones we have for sale in Georgia, Massachusetts, and Michigan right now, those are large enough transactions, like they could go into a region and form a platform and create the ancillary companies.
Right, but are you looking at that and you're explaining that, hey, this is worth this amount because you're able to build on other ancillary companies? Or is it a market value that you're looking at at the real picture of the value of just the SNF?
We're selling the properties based on what the SNF operation is producing, that 12.5 cap. But we certainly emphasize the fact that if you are a regional player, this is a regional portfolio, and all the properties are within an hour and a half drive of one another. So if you do have ancillary companies, that's just another aspect of making a profit. And many times the reason that's important is because there's CapEx that's needed in the buildings. There's, maybe the occupancy due to COVID or other factors is not where it needs to be. Look, it's a very difficult business. First of all, I think you have to have a contingency plan. One of the things that I really admire, again, about companies like Aparian is they're so good at, I wouldn't call it plugging holes, but let's say that you plan on something working. And as we all know, life's not perfect. So you plan on going this direction, and then life throws you a curveball, whether it's COVID or something else. Well, there are some companies that are way better than others at solving for that. Like it's almost like you're taking a test, and it's like those food shows where you're making something and they say, oh, now you have to include pineapples, and you're making steak or something. It's like, what? So it's kind of like the nursing home business. Like you're making something beautiful, and then all of a sudden it just goes left on you, and so you have to respond to that.
Basically, from what I understand, you're saying is some of the larger groups are purchasing homes based on a lot of the ancillary business profits, which drives up the prices. And then when you're doing a comparison with the nursing home next door and said, hey, this sold for this amount,
right?
So this is also worth this amount per bed,
right?
But that's not the reality. So they're technically pushing the smaller players out of the market and saying, hey, there's no way you're going to be able to compete,
right?
Because you're not going to be able to survive unless you have the bandwidth,
right,
to service.
I think that's a very astute statement and an accurate statement. I think it's going to be it's very tough already for the small guy to make it, and I think it's going to be more and more tough. And look, I think there is, depending on how you look at the world, I think there's a case to be made for the big guy making it, because that sounds too capitalistic these days. I'm not trying to be political about it. I'm just saying that those of us who complain about Walmart, we shop at Walmart because toilet paper's, I don't know what it is. I don't shop at, my wife does most of the shopping, but let's say it's 20% less than the old stores that we used to have, or Home Depot. We used to have Western Autos and things like that. And these companies that are massive and have these great purchasing power benefits, I mean, we're benefiting from that as customers. Amazon, the reason Amazon sells things cheaper is look at the market they have. So I think in the nursing home business, the small guy, small person, it could be a woman, the small operator is just going to have a tougher and tougher time because they don't have the group purchasing. Even though you can join a group purchasing company, still if you have a lot of volume, you can either form your own GPO or you can have more benefit of discounts by buying more. So you have that to your favor. You have more power with the pharmacies, the therapies. You either have your own that you form and create the profit centers like we've been talking about, or you're a better negotiator with the other companies that are providing the services.
You guys heard it first on the Sniff Spotlight series. We got Mark Meyers. You don't want to miss this. That was amazing.
Oh, thank you.
That was like a serious education. I feel like I have a master's degree right there. The Sniff Spotlight series would like to thank the Renewal Rehab family for sponsoring this program. Renewal Rehab is the best therapy provider for SNFs nationwide. So if you're an owner or an operator of a skilled nursing facility and you want contract therapy, you are going to want to call and connect with Renewal Rehab. This series is geared towards highlighting healthcare leaders as well as healthcare heroes in the SNF space. So thank you all for watching and supporting this program.